Hello, everyone. Thank you for joining us this evening. It is 6 o'clock, so we're going to go ahead and get started. I just wanted to do a little bit of an introduction. Thank you again for joining us. We are excited to have the opportunity to review the home buying process with you. I wanted to introduce Victor Bradford with Engel Völkers. Victor is a seasoned agent who is passionate about helping his clients navigate the home buying process. I'm Cynthia Stewart. I'm the Senior Mortgage Loan Officer here at Ideal Credit Union. Been here for 33 years and about 15 years doing origination. I love educating buyers so that you can make really good informed decisions and understand the process. Please enter any questions in the chat. We will try to monitor those. If we're getting too many questions or don't have time, we can do that at the end. So thanks again for joining us. We're going to go ahead and get started. This is just the agenda for this evening. We're going to go over the goals, the home buying process, defining key terms, and then we can have a little question and answer at the end. So welcome. Again, I'm Cynthia Stewart with Ideal Credit Union. And our goal today is just hoping that we're going to take you through the various steps for owning a home. Hopefully get rid of any fears that you have. If you're, the more you know, the better it's going to be, right, as you go through that process. And then just have a really good, confident understanding of the home buying process from the beginning to the end. So this is just a little bit of a timeline of what it looks like. So I really suggest that everyone, meet with someone like myself, a mortgage loan officer, advisor, someone that can go over all the different aspects for you, work on getting you pre-approved, go over all the numbers and kind of what to expect. Once you're finished with me and we've pre-approved you, and we're going to get into that a little bit more detail as we move forward, then you're going to work with someone such as Victor, and you're going to be going on that home search, and he's going to walk you through that, writing up the purchase agreement, the inspection, once you have an accepted offer. So you kind of start with me, move over to your realtor, then I come back in the picture to get us to closing and go over all those final numbers and collect any title document, or loan documents and things like that we're going to need for the transaction. And then you move to closing. So we're going to go over, when I meet with you, we're going to ask you things like, what is your timeline? What is your goal? What type of house are you looking for? What payment are you comfortable with? We can say that you're approved up to a certain amount, but I think what's really going to matter is what's an affordable payment for you in with what you can actually get pre-approved for. What are the requirements that you're going to need based on the mortgage that you're going to qualify for? Each one has a little bit different qualifications. There are some different down payment and assistance programs that we might be able to help you with. And then hopefully we can build some trust and have some good communication during the process. So when you're looking at the, timeline and why to buy a house, everyone has kind of a different motivation. Maybe you want a yard, you don't want a yard, you want a dog, you want to personalize it to make it your home, be able to paint it the colors that you want. You get to build equity. And that's a really nice thing. I know myself as a single parent, it was really nice to have that equity in my house as I was moving forward through life. It did help me do a lot of things, being able to pull that equity out and do some different things. You can have more stable payments. Now, payments do change a little bit because the taxes and insurance change, but the base part of your payment, if you're in a fixed loan, will stay the same. So that can be a nice part of also owning a home. And then even though there might be some increases, you're building equity, which again is a benefit to you versus over renting, helping someone else build equity and having more of a say in how you use your home. And I do meet with people. Sometimes their timeline is 2 years, a year. Sometimes they think it's going to be a while and they find the perfect home and then they're ready to go. So everyone's journey is going to be different. And it's Never too soon to speak with someone, because that's going to really help you know what funds do you need? What do I need to be prepared? Where is my credit at? And here at the credit union, we do pull a soft pull credit pull, which is not a hard hit. So that can be a really nice way to be able to look at that and see where your credit is, which helps to know what loan product. So when we look at your goals, again, is it a primary residence, a vacation, or investment? I'm thinking most people here today are looking at their primary residence, their first purchase. Thinking about location, that can really make a difference in what those purchase prices will be, property taxes, those type of things. The type of home that you want, each one is a little bit different. When we think of, they're all technically single family if you're the only one that's going to live in it and you're not owning like a duplex where you're going to rent one side. So single family detached would be typically the house, the garage, and the piece of property all by yourself. We can also do condos and we can do townhomes, and you can buy multifamily. For the residential side that I'm in for lending, you can go up to a 1 to a 4 unit property. Looking at what your long-term goals are, again, looking at what your affordable payment would be, and then the max payment that you feel you would be comfortable with. Again, I can get you approved usually up to about 45% of your gross income, which is before any deductions, but that doesn't mean that that's a comfortable payment for everyone. It's going to depend a lot on lifestyle and kind of where you're at in life. Credit. This is a really big piece of the mortgage process. It determines maybe what's the best loan product for you. And so really paying attention to your credit is important. It's showing lenders, are you successful with making your payments? Do you make them on time? And this is kind of the breakdown, this next slide, of what's in your payment. And this is all that it really takes to know what's in your credit score. MyFICO.com is a great resource, and it has an education tab that shows this wheel, and it breaks it down. So the 35% is pay history. So you have to have some things reporting to have pay history, and that's 35% of your overall score. So it's very important that your payments are on time. The 30% piece of that is typically referring to credit card usage, the balance that you have. So if you had $1,000 credit card, you'd want to keep that balance at about 300. That would be about 30% of your overall available credit. They kind of assume that if you have a higher balance than that there might be a reason for that. So they're looking at you using about 30%. New credit and credit inquiries is about 10%. Pay history is not pay history, length of credit is 15%. And then mix of credit is 10%. So mix of credit, what that means is I kind of equate it to going to the grocery store. Most people don't shop in just the produce or just the meat aisle or just the bakery or deli. We usually have a variety from the different areas that we shop with. So the same with credit. Maybe you have a mortgage, a car loan, a couple credit cards. So that would be a mix. Each one of them is a different type of what they call a trade line. So for instance, a mortgage is filed under mortgage. A credit card is under revolving. A car loan is considered an installment. So in that sense, that's kind of a mix of credit. So if you think about length of credit history, you can usually have credit from, let's say, 18 to 90 as an example. So that's like 72 years. So if you're just starting out and have 5 years worth of credit, and then you have a late payment, that's going to bring your score down a lot faster than if you had maybe 20 years of history. So that 15% plays a part in all of the other things that they all work together. So they're all important. So the longer your history is, the less effect some of the other things will have. A shorter history, they're going to have a greater effect. So one thing you might want to do is get like a major credit card. When I started here at the credit union 33 years ago, I have my Visa that I opened with the credit union. So right now I have 33 years worth of credit history. So that gives me a little bit of that longevity. So that's what they're kind of looking at when they're looking at the credit scores. History, amount you owe on your credit cards, your length of history, how much new credit and credit inquiries are you doing, and then your mix of credit. And it really does all work together. And I love educating on credit. Once I've seen your credit report, I'm very happy to give you information that I think that could help your credit. Some people think, well, I paid it faster. Paying faster is not one of the things on the wheel. So if you pay a debt faster, that's great for you. You paid it off faster. But the payment history, just that it's coming each month for the right amount, is what they're scoring you on, not that you paid it off faster. So that's one thing to think about, is your credit and where you're at. And that's going to be an important piece as you move forward through mortgages. So these are some credit building tips. We kind of talked about that a little bit. Keep your credit limits at that 30% or less on your charge cards. Don't close ones that are older, because again, that goes to that length of credit. So if you can find a credit card or something that you like that you can keep, you also don't want to close something while you owe a balance. So if you had $1,000 limit on a credit card and you owed $900 and then you closed it because you decide, oh, I don't need that card anymore. If you close it while you have a balance, now instead of being at 90% of your limit on the $1,000 card, you're negative because you didn't have a limit now. You closed your limit. So you're now a negative versus being just having a limit. So you don't want to close anything if you feel you really need to close it until you're at a zero balance. You can utilize the freeze, your credit monitoring. Just make sure that you do remember how to unfreeze it. So make sure you keep that information handy so that when you do need to unfreeze it, and if you do have it frozen, we do need it unfrozen at the time you apply. And we do a soft pull, and the soft pull here at the credit union, we pull Equifax and TransUnion credit reports. So those would need to be factored into there. Those would be the ones that we would want to have unfrozen. You can add yourself to someone else's credit card. That's going to give you kind of their pay history. So that can sometimes also help. Make your payments. Yep, make your payments consistently. Yep, that's a good one too. So looking at monthly income, what do we look at when we look at the income piece? So the income, we can typically approve you up to 45% of your gross income. And if you're an employee, that would be before any deductions are taken out. So if you work at a company like I do, I get my pay. They're looking at my gross income before any deductions. If you're self-employed, they're going to look at after you write everything off. So let's say you have $100,000 in gross, $100,000 in sales, but you write off $50,000 in expenses and then show your income is $50,000. That's what we're going to use as that $50,000, because the other ones you're saying you spent on stamps or cell phones or gas, which means you don't have that in your budget anymore to spend. So it's going to be what your income is after you write everything else off. So every different income is looked at differently. If you have tips, commission, bonus, overtime, things like that, there has to be a history, and then they average that income. So we would need to see a history of it, and then we would average it. So in the example here, both borrowers make $5,000 a month. That would be $10,000. Of that, you can have 45% of that in debt. That would include your car payments, your credit cards, alimonies, spousal maintenance, child support, the snowmobile loan, the loan you took out for the furnace, whatever those loans would be, anything that's reporting. So we don't look at car insurance or cell phones or like your utility bills. So it would only be what's on your credit report typically. We can go up to 45% of that. So in this example, they're showing a purchase price of $550, a down payment of $27,500, interest rate 6.875, 30-year loan. And this is just an example of what a payment would look like. So the principal and interest portion of that payment is the part that's paying down your loan amount. Then we need to add in homeowners insurance, property taxes, and this example assumes that you did not put 20% down and you're going to have mortgage insurance. Mortgage insurance is a product that if you don't put down the 20%, you do need to have this extra insurance that protects the lender in case you default on the loan. And that's what mortgage insurance is. And so altogether, this estimated payment would be right around that 4,400 mark, which would fit with the 4,500. I do want to add, though, I would never want you to go up to 45% in your mortgage payment, because you need to leave some money left over for a car payment, maybe daycare, maybe your dog gets groomed once a month at the groomers. We all have a lot of different expenses in our life. So we want to make sure that that mortgage payment also fits into your lifestyle. Do you travel? Do you have kids? Maybe you want to have kids. There's all different things we want to think about. Do you bird watch and you go on a trip every year to bird watch in some other part of the country, right? Maybe you play softball or golf. You're meeting up with your buddies, your friends once a week or a couple times a week for practice in a softball game, and then heading to the local spot that's sponsoring you. So we just want to make sure that that payment still allows for you to have the life that you want to live as well. Plus, houses also need to be have some maintenance done to them, or some upgrades over time, or the cabinet broke, or whatever it is. Oh, we need a new furnace. So you kind of want to look at, like, a townhouse and condos have HOAs. Part of that is supposed to be kind of looking at the future expenses. So you as a new homeowner would also want to look at, what are some of those future expenses? And I will get back to you, Tony. I'm going to keep going for right now. See, I had paid off all my dad's mortgages. I had 2 years without credit payment history and was having a hard time getting approved for a mortgage with like credit. Yep. So the thing is, you have to have a credit score to get a mortgage. So what happens is, if the 35% of your score is based on history. So if you do not have any history, you will have to get some debt to be able to get that credit score back. If you have a history that's just been laying quiet, once you acquire some current debt and it has some time to season, your score should come back, but you would have to have that. So would love to talk to you a little bit more, maybe even have you apply and pull that pre-qual credit report that's not a hard hit, and then we could talk through that and come up with a game plan to get you into the house. There's different loan programs. So once I meet with you, we know what your credit score is, your income. The credit score is going to be the big part into what loan. So for instance, if you're a veteran, that's a great loan. It's 0 down, no mortgage insurance. So that's a really great loan to take advantage of if you're a veteran. Most common is a conventional. With a conventional, if you're a first-time home buyer, you can put down as little as 3%. That one has typically a lower cost of mortgage insurance than the FHA loan does, but it depends on credit score. So the conventional, everything tied to that, the cost of the mortgage insurance, your interest rate is all tied to that credit score. So someone with a lower credit score, let's just say 700 or under, might look at a Federal Housing Administration loan or an FHA loan. An FHA loan is a government-backed loan. So when we were talking about the mortgage insurance, on the conventional loan, the mortgage insurance is provided by a private company. So it's called technically private mortgage insurance. On a government loan, it's provided by the federal government. So everyone on a government loan pays the same rate for the mortgage insurance regardless of credit score. So with a lower credit score, that is typically going to be the better option. And with a higher credit score, a conventional loan would be the better option. An adjustable rate mortgage is also technically a conventional mortgage. They offer a fixed rate for a period of time. So a 5-1 arm, the rate would be fixed for 5 years, and then it can start to adjust. A 7 would be fixed for 7 years and then can start to adjust. So those can be a good product. So recently I have a loan right now. They could save about $330 a month if they took the 5 or 7 year arm. So if you do that over the 5 years, that's a really nice savings. You can take that savings and apply it to the principal of your mortgage, the amount that you owe, and then you're going to pay your mortgage down faster. Or maybe you take that $300 and put it in an account for those future things that you're going to need to do for the house or back in your budget. Now, there is a little risk because after the 5 years, the rate can adjust. It can adjust up to 2%. So maybe not for everyone because you want to be able to sleep at night. So if you're the type of person that getting an ARM is going to make you nervous, not a good product. Matter of fact, that couple that I was just talking about, they went with a traditional conventional with a fixed rate because they just don't feel comfortable with an ARM. So it's not for everybody, but it can be a great product. We do have a zero down program here at the credit union. All of the other loans have a 30-year amortization. That's how long it's going to take you to pay the loan off if you only made your minimum payments. A zero down loan has a 25-year amortization. So because you're putting zero down, we want you to be able to build that equity a little bit faster. So that can be a great product. Then you only have to come up with the closing costs. So with a mortgage loan, there's 3 parts to the money. You have your down payment. So that's the amount that you need to put down. A first-time home buyer for conventional is 3%. If you've owned a home before, the minimum is 5%. FHA is 3.5%. Doesn't matter, first-time home buyer, everyone is 3.5%. VA loan is 0 down. An ARM is 5% down. And Community Heroes program, that one I believe is as low as 1% down. So that would be for like nurses, firefighters, I believe teachers. So that is a great product in that area. So those are the different types of loan programs. Credit score is going to have a big part in how that plays out and which product we think is best for you. Some of the down payment assistance programs that we have here, we are partnered with Minnesota Housing. So it's in Minnesota's benefit to have people own homes. Usually when you own homes, you're a little better in the community. You take pride in your home. So they like to be able to make it affordable. So they do have some different options, and we can come up with some of the closing cost money from that. I think I kind of segued away. So the 3 parts of the money were the down payment. Then you have to have closing costs. And the closing costs are the lender, the title, and the government fees. And then the other part would be your expenses that are collected at closing for things like homeowners insurance and property taxes and interest in the month you close. So if you take all 3 of those and together, that's the amount of money that you would have to bring to closing: the down payment, the closing cost, and then your expenses that are at closing. So if you did a 0 down loan, then you don't need any down payment. You would just need the closing costs and your expenses. So Minnesota Housing has a great program. They have up to 14,000, and then they have up to 18,000. It's going to depend on how you qualify. So your income limit will depend on what loan option that you can have and the amount of funds that you can get from them. So that's a really nice program. We also are part of one of the Federal Home Loan Bank of Iowa this is the 2nd year that they have had this mortgage rate relief program. It currently has a phenomenal rate of 5.125%, but it is on a first come, first serve basis. So right now they're at about 58%. So there could be time if someone's ready right now and is able to go out and maybe get a purchase agreement quickly, we might still be able to capture that rate. But that is really nice and a really feel good for me when I can offer somebody a 5.125% interest rate. The going rate right now is about 6.75%. Fannie Mae for the conventional loans also has an income guideline program called Home Ready. That rate's probably about 6.5%. So it's usually maybe about 0.25% or so lower than the normal 30-year going rate. So that can also be a really nice option for a homeowner. So getting pre-approved. So the first thing that we want to do, getting you pre-approved, would be to get an application, take a look at your income. okay, what is your income? What do you think your credit score is? What are your debts? And I can kind of manually figure out what I think a payment would be and where you would fit. You can also apply and we can, pull the pre-qual credit report. We can actually get all the income and everything. A realtor wants you to be pre-approved, not pre-qualified. They want to know that you've gone through the steps. So I always tell people, think about if you were putting your house on the market and you're getting ready for a showing, and they're bringing people in that don't qualify, right? So it's kind of want to make sure that for the realtor's time, your time, and the seller's time, that the people that are actually coming to look at the homes could buy the house, that they are qualified. So that's what the pre-approval process is for. So you're going to fill out an application. We're going to pull that pre-qual credit report. We're going to verify your income. Do you have the assets and the resources for the funds that we're going to need to close? What are the current interest rates? And go through that whole process and make sure you understand. We're going to pick out which loan option we think would be best for you. Conventional, FHA, VA, the zero down program, and figure out which one is the best option for you. And once we do all that, then I can issue a pre-approval letter. The pre-approval letter that I issue is really for your realtor to know, hey, Victor, I've looked at this couple. They're going conventional. They have, 5% down or 3% down. They're qualified to do the loan, then they know what search to set up for you and can feel comfortable showing you homes in that price range. So it's kind of for them to kind of know where to start and to show that you're pre-approved. Once you start making offers, they're usually going to ask for a letter that takes off the amount and puts in an address. So my first letter would say purchase price, say 300,000. Then when you go to make an offer, I'm going to take off purchase price on my letter and send a new letter that says property address with an address. That tells the seller that I've looked that property up, reviewed it with how you qualify, and that I'm saying that you are able to move forward with that. We talked a little bit about this already. What are the components of your monthly payments? Principal and interest. Once you've got a purchase price, you put your money down, that is your loan amount. The principal and interest payment is paying back the loan amount. So that's the amount each month that reduces. We spoke about for just a little bit. So that's going to be added to your payment. The county that you live in has property taxes. Property taxes are paid twice a year. We're going to take the annual amount, divide it by 12, and that's added to your payment. If you're doing a conventional loan and put down 20%, you can choose to pay your homeowner's insurance and taxes on your own. But if you have put less down, or if it's an FHA loan or a VA loan, they always collect the property taxes and homeowner's insurance in the payment. If you do a property that has an association dues, typically that's a condo or a townhome. However, in Woodbury, it's very common that the neighborhoods have an association. When you drive through Woodbury, every neighborhood usually has a sign and some, nice trees and shrubs at the entrance, or brick monuments or things like that that say the name of their neighborhood. Well, someone has to pay for that, so the homeowners do. So some neighborhoods have associations for their neighborhood, but it's typically more common in a townhouse or in a condo. Association dues are always paid directly to the association. We do not collect them each month, but we do take them into consideration for qualifying you. So to qualify you, we would have to look at that full payment, the principal and interest, mortgage insurance, property taxes, homeowners insurance, and the homeowners association dues, if it's part of that. Then the closing costs. Lenders have an origination fee, an appraisal, the credit report. So those would be our cost. The title company usually has a package price for what they're doing for you. They're checking on the title work to make sure that when the house goes to you, that you own it without anybody else. Basically, the title is free and clear. So they have some fees. They have a fee for the person who comes to your closing. And if you've ever bought a car before, when you go to register that car here in Minnesota, you pay a registration tax, a conservation fee, and then there's also for a mortgage, there's a couple doc fees. And then you're going to prepay for 1 year of homeowners insurance. And you're also going to have some money set aside for taxes. And escrow, what escrow is in the payment when we collect the property taxes and homeowners insurance, the lender sets it aside in an account that's labeled escrow. So basically it's your money. We're just holding it, and then we're going to make those payments for you. So the homeowners insurance, the lender would pay once a year. And then the property taxes in Minnesota are paid twice a year, April and September. So at the closing table, the title company is going to figure out what part of the taxes have already been paid or not paid. If the seller's already paid the taxes, you might owe them a little money. If they're living there during a time that taxes are being owed, then they're going to owe you some money at the closing table. So all those things get figured out with all the numbers, and all of those together are what you need to bring into closing. When you come into closing, you bring one check for the whole amount that's due. The title company is the one that collects the money. They typically want a cashier's check or a wire of the money sent to them. So it's a lot of information, but when you meet with me, I will make sure that I break it all down. I can show it to you, explain it, and go over it, hopefully for a way that you'll be able to understand it and make it not seem so much, I guess you could say. We do not need to put 20% down. First-time home buyers conventional can put as low as 3%. 5% is the norm. FHA is 3.5%. VA is 0. So you do not have to put 20% down. However, there is mortgage insurance if you do not have 20% down on a conventional. FHA always has mortgage insurance regardless of the down payment, and a VA loan never has mortgage insurance. You do not have to retain your original mortgage for a certain number of years. You can pay it off at any time, sell it at any time. So there is no expectation that you have to keep it for any certain time. Buying is always better financial deal than renting. That really would depend. Everyone is different. So some people don't want to be tied to a mortgage. They might not feel that that's the best option for them. Majority of us do want that American dream and to own our home and to build that equity. And that's something that we really look forward to. Sometimes a mortgage payment is a little bit more than a rent might be, but at the same time, you're building the equity, you have that tax write-off, and the tax write-off is going to depend on what your income is. So that all depends. Everyone's situation is going to be different on how they pay the taxes. All right, we got a couple questions here. Let me see. Is there a general range for the closing costs? Some people say 3% of the loan amount. I tend to like to figure it out for each one because it is a little different for everybody, but some people say it depends. No, most of the costs are not dependent upon location. So for instance, like our origination fee is based on the loan amount. The appraisal is the same for everyone, the credit report cost. So a lot of the fees are set fees, and then some are based off of the loan amount, like the registration tax that the county charges. It's 23% for the majority of the counties. Ramsey and Hennepin are 24%, 24 cents per $100 of the loan amount. So some are based on the loan amount and some are based on the actual just flat base costs. And then for some of them, like your homeowner's insurance, you're going to shop and get the homeowner's insurance that you want from your preferred. So the cost of your homeowner's insurance would be whatever your cost is when you go out to shop for that. The mortgage insurance, yes. Well, okay, so technically on a conventional loan, for the first 10 years, the mortgage insurance is at one price. And then once it gets it will drop a little bit if you still have it after a period of time. But yes, basically it does stay the same the whole time once it's set. Your taxes and insurance will go up or down because the county will change the cost of your property taxes and also the cost of your homeowner's insurance. So those parts of your payment will change. So I hope that answers your question. If not, we can certainly talk a little bit more about that. Would love to connect and go over it with you. Home buying tips. Yes, once you get pre-approved, do not do any more shopping or have your credit pulled. We will know. We're monitoring it in the background. And then if you're in the process of being closed and you go out and no get a new payment or have your credit pulled, we're going to know that. And then we have to add that payment in. So sometimes it just happens that maybe you're in process and oh my goodness, you need a new car. It doesn't mean that you can't do that, but we need to talk first before you have your credit pulled. Make sure that with that payment, you're still going to qualify. You want to make sure you keep making all your payments on time. Don't move money around. The more you move money around, every time it moves, if it shows on your bank statement, we have to prove where did it come from? Where did you move it from? And then we're going to need more statements. So it's usually better to wait, get everything verified, and then right before closing, if you want to move money, let's say to all one central account, then you can do that. So those are all things that we would go over with you. And then don't quit or change your job. Once you get pre-approved, it's on that job. Now, let's say I get you pre-approved, you haven't found a house yet. Oh my gosh, that great opportunity comes up for a job. You can take that job, but then we cannot close on the mortgage until you've been at that job for 30 days and we've had time to verify it. So let's say it would be 30 days plus maybe another 5 days because we got to wait for you to get that pay stub to get to us, or for us to be able to go out and do a verification of that new employer. And then we just want to make sure that you still are going to qualify the same. So if you quit your job and don't have a job, then we can't go forward. If it's just a new job, you just have to be at the job for a period of time before you could close on a mortgage. Yes, you can certainly close on a mortgage with no real estate agent. That does happen. I find that more when it's like families, like mom or someone and you know someone. But really, in almost any situation, it's really good to have a real estate agent. There's just so much that they bring to it, especially if you're buying from someone you don't know and you're trying to negotiate or navigate that market. So I'll let Victor talk a little bit more about that. But having someone with experience that knows what the market is doing, that can negotiate for you, keep in mind, they want you to find a house too. So they're going to work really, really hard for you to find a home and to get you into a new house. So yes, you do not have to have a real estate agent to buy a home. You have to be able to provide a purchase agreement, a negotiable legal contract that says that you're buying the house. So, yep, you can certainly do that. So now that you're pre-approved, what's next? Well, what next? I'm going to let Victor take that over. So I hope that you found some of that information valuable. And I'm going to let Victor talk to you now about once you get pre-approved, now you move on to Victor and he helps you buy a house. So give us just a second while we change screens here.
All right. Here we go. Am I live? Do you see the screen?
Yep, I can see you, Victor, and I can see your screen.
Okay, perfect. All right. Well, a little bit about me. I am from South Florida originally. A lot of people are like, what are you doing here? Well, I married a Minnesotan and they always tend to come back. So so far it's been great. Love the summers. Summers in Florida are really hot, but the winters are a little brutal on me. Still trying to get used to it, but it's all right. All right, so some defining key terms. So Cynthia kind of touched a little bit on this. There are a lot of players in a transaction. There's a buyer agent, listing agent. The buyer's agent is the agent that's representing the buyer. Listing agent is the agent that's representing the seller. Sometimes they work together, like in the same brokerage, but most of the time it's usually one company, not versus another company, but kind of go like that. There's the lender. Cynthia would be the lender. There's the inspector, which is just a third party that we would hire to make sure that the home that you're purchasing is safe, it's in good condition, and you usually get a giant report of everything that's wrong with the house, but typically you're just looking for like those major issues. like, the furnace is not working properly or the age of the furnace, if there's any leaks. And they go pretty extensive, and we'll kind of touch a little bit more about that. There's the appraiser. It's a third party that makes sure that the house that you are purchasing is valued at what you're paying. So obviously the bank is not going to give you more money than what the house is worth. So we'll talk a little bit about that. Title is another third party that transfers the ownership from one party to the other. So they're kind of like on the back end, making sure that the title, that the house is clear of any kind of liens, mechanical liens. Nobody else owns it. Gives a list of people that have owned it prior, and just make sure that it gets recorded properly with the courts, and that it's yours and yours only. Agency just kind of defines these things. Who is the buyer agent? Who are the sellers? What dual agency is? Those are important to know so that you're aware of who the key players are in a transaction. Purchase agreement, that is going to be the contract that we write the offer in to present to the sellers, and we would go through it together. It's like 20-something pages, and yeah, it's very detailed. We'll talk more about the purchase agreement and what it entails. Oh, we got a question. Yes, we do through a partner. Oh, that's Cynthia. Okay. All right. Choose your advisor. So if you look on the bottom, it has the timeline of a typical transaction. Choosing your advisor is just, working with someone that you trust, that you honestly make it fun with, because it can be a stressful situation, going out, looking at homes, multiple offers. So if, finding someone that you trust, that you have a good time with, can have a few laughs, is always great. Why are you moving? Sometimes the family is growing, you're having more kids. There's a life change. Sometimes people get divorced, unfortunately. You can get an investment property, get an Airbnb, dabble into the multifamily world, or you're relocating. So there's lots of reasons why people are buying, selling. So yeah. Getting pre-approved. Well, Cynthia already kind of went through that. And she did such a great job. I actually wrote some things down that I didn't know. So that's great. Now we get to the fun part, finding the home. So as far as the property itself, it's always a good idea to get an idea of what you're looking for. Do you have pets? Do you want a fence around the home? There are also some deal breakers to consider. Some homes are located near the highway or right on the road. So those are some things to consider. You will most likely get a good deal on it, but the resale value might hit you. So those are some things to consider. Also, how long are you planning on being on the home? Maybe it's just, a temporary home that you'll be in it for 5 years, or it'll be your forever home. So those are a lot of things to consider when looking for a home. Number of bedrooms, baths, the neighborhood is very important, because you can change the inside of the home. You can update it, paint colors, but you really can't change the location. So finding the right neighborhood, the right school district, if you're thinking that far ahead, is really important. But at the same time, just being open, because it's very limited out there. So if we can find something that that checks 8 boxes out of the 10, that's a win. All right, purchase agreement. So the purchase agreement, like I mentioned earlier, is the contract that we will fill out together to present the offer to the sellers. So by then, we already have our pre-approval letter, so that we're going to be attaching that to the email. and then we're going to fill out the purchase agreement. And it's going to have a couple of important details on it. It's going to have, what you're offering. So if the home is 300,000 and you're offering 315, we got to put the purchase price. We're going to insert the earnest deposit, which is typically a minimum of 1% of whatever the purchase price is. So if it's 300,000, you're going to put $3,000 down. And that is going to be held in an escrow account held by the listing agent. And that is just kind of showing that you have skin in the game. You're going to have to deposit that within 2 days of an accepted offer. And that money is going to be used towards the closing. So you'll see it as a credit in your ALTA that you'll receive towards the end of closing. You'll see it in one of the itemized lines that it's a credit. Now, this earnest deposit is safe because during the process, you're going to have an inspection period, and we're going to talk about that. And during that inspection period, you have the ability to do the inspection, make sure that you feel comfortable, that there's no buyer's remorse, and you're able to back out from the contract during that period, which could be 3 days, 5 days, 7 days, whatever the days is. You have that time to really do everything that you need to do to make sure that this is the right home for you. During that time, you can back out. You wake up with a headache, you don't feel good, you can back out, and you don't lose your earnest deposit. Once those days are over, though, you are locked in. And the only way really to get out and not lose your earnest deposit would be you lost your job. Something drastic happened that you are not financially capable of purchasing the home. That would be the financing contingency. But other than that, you're going to lose your earnest deposit. So it's kind of, it's great if you put more than 1% down because you're showing, that you're committed and that you really want this house. But it is a small risk throughout the transaction. So those dates are very important. Also, on the contract, it's going to have dates, the closing date. So typically it's 30 days. Sometimes there's 45 days for a closing. And those things are important. They got to be on the contract. Also on the contract, it's going to have consequences of what happens if you don't abide to the legal agreement. Just as like you would lose if you decide to back out after your inspection contingency, the consequence is you would lose your earnest deposit. So the contract really states a lot of the details and the consequences of what could happen if anyone broke the deal. Inspection. All right, your offer was accepted. Awesome. So during this inspection period, you're going to have a couple of things happen. So one, we're going to decide whether you're going to have an inspection or not. Two, how long you're going to have that inspection for. So like 3 days is pretty good. I mean, that's pretty solid. 5 days is a little long, but I've seen them get accepted. And during those 5 days, just as I mentioned earlier, you can do a general inspection, which the inspector goes into the home and basically checks it from the ground up. I mean, he checks the basement, any kind of water intrusion. He'll look at the blocks, if there's stains on the windows where the water was seeping in. He'll document all this. So you'll have pictures and descriptions and locations of all the things. He'll go into the attic and check the rafters. If there's moisture on the rafters, he can check it with a moisture meter to see if it's an old leak or if it's a new leak or if it's there right now. He gets on the roof if weather permits. Feels the sheathing under the shingles. I mean, he he's there for like 3 hours. So you're going to get a pretty thorough report. He makes sure that all the appliances are working properly. He runs the dishwasher, checks the P-trap for any kind of leaks. I mean, it's very thorough. And that's the general inspection. And it usually costs around $400, $450, depending on the size of the home. If you're getting a mansion, like a 10,000 square foot house, it's going to cost more. But typically, it's around $400. There's also radon inspection. That is an inspection to check the gas levels of the radon. So it's typically in the basement. And anything over 4.0 is considered hazardous. So they'll have this little machine set up, and it takes about 4 days to read the home. And then you'll get a report at the end of the 4 days or 5 days. And it'll tell you, the average radon gas levels is 2.0 or 3.0 or 6.5, which I've seen before. So if that's something that you're worried about, you can do a radon inspection. I think you can add that on, so it's like $250 maybe. Sewer line inspection, very important. Even on an older home or a new home. I sold a house last year in November in Maple Grove in a newer developing neighborhood. I mean, it wasn't 2020 or 2025, but it was, 1998, something like that. And they had a cracked sewer line because they were doing some construction in the area, and the vehicles were too heavy, and it crushed. Well, it didn't crush, but it cracked the sewer line. And I mean, that's an expensive fix. That's like $15,000, $20,000 fix. So even if it's an older home or a newer home, I highly recommend a sewer line inspection. You get that report immediately because it's a camera that they stick through the sewer line, and they'll know if they see anything, and it goes pretty deep, 40 feet, 100 feet. So they'll check it, and highly recommend it. They also have well inspections, mold inspections, structural inspections, septic tanks. Some cities require TISH inspections that the city requires them to have a similar inspection to this, but not as thorough. But yeah, let's see. Maggie, how much is it to add the sewer line inspection on me? I've seen some for like $200, $250. Just depends on the company. It's usually the same company, but it's not crazy. And I mean, I really recommend, especially if there's a giant maple tree in front of the house. Usually, you'll have some of the roots kind of penetrate the pipes. So, highly recommend it. Yes, well worth the cost for sure. Kind of talked a little bit about the inspection. It's going to depend on the size. I talked about if we have 5 days, we have 5 calendar days to hire and complete the inspections during that timeline. So you have 5 days to think about it. I mean, I hope not, but you have that time to think about it and kind of like, really think about moving forward on purchasing the home. During those 5 days, you have the right to negotiate any significant repairs. And when I mean significant, I'm not talking about like the outlet doesn't work. I mean, it's a little silly. But if there's an FHA loan and they require some things to be more up to date than a conventional loan, so that's very important. The FHA appraisal will come. We can talk about appraisal later, but might as well talk about it now. If it's an FHA loan or a VA loan, and there's no like GFI outlets near water, like by a sink in the kitchen, or the roof is significantly older or it's visibly damaged. If there's peeling paint, it's a huge one. Peeling paint, that's a nightmare in like older homes because pretty much almost all the homes that are older have peeling paint. It won't pass. So it's very important to inspect those things prior to even making an offer, because you're just going to waste your time. Or we can negotiate with the sellers to like, hey, can we get this painted, or can we get this fixed prior to the appraisal? Because it's gonna come up, and it's just gonna cost you time and money, and it's very important to even just to determine from upfront, like what kind of loan is it, what kind of homes we're gonna look at, and then go from there. Yeah. Yeah, we talked about once the offer is accepted, you have 2 days to deposit the earnest deposit, and usually it's done through trust fund, and it's online. So I send you a link, and you'll have a secret password. Usually it's going to be funny because I'm goofy. It'll be a funny password, and once you log in, it wires the funds to the listing brokerage, and they get a notification that you have deposited, and it's just held there. And it's that simple. So they charge like, I think it's like an $8 convenience fee. You don't have to like write a check, go to the bank or whatever. So it's just online, and that's usually the preferred method. All right. So now the inspection is over, and like the inspection was over, and today is the last day of the inspection contingency at midnight. That's when it's over. That makes sense. So congratulations. Now it smells soothing. Can't talk. Smooth sailing, kind of. So now at this point, you're going to just be turning in more documents. I'm sure Cynthia is going to be asking like for this and that, and that's normal, part of the process. Do not buy anything. Do not buy a boat. Don't get new credit cards. Don't go on vacation, and don't be moving around any money. So very important. And next up is once you have the executed purchase agreement, that's when Cynthia will start to order the appraisal. And that's when it happens. So when the appraisal happens, they'll set up an appointment. And by the way, all this is happening. I mean, you're at home and you're enjoying your time with your family. This is all happening like in the background. She's going to order the appraisal. You pay for it. Usually, depending on the house, but it's around like $500-600 for the appraisal. They'll set up, the appraisal company will set up an appointment with that home, and they'll go and they'll show up and they'll do their thing. Like, you don't have to be there. I don't have to be there. Yeah. So the appraisal is going to be a third party that just is going to verify that the house is worth what you're offering. You know, if you're buying a $300,000 house, and you put an offer for $400,000, which is not uncommon back in 2021, there's going to be appraisal issues. You know, it'll appraise for like, let's say $350,000. Well, now, you know, someone's got to pay $50,000 or bring down the price. You know, so there's a lot of things that could happen. So more realistically, in a present time, let's say the house that you're purchasing is originally $300,000. And it's not uncommon to put an offer for $325,000, $330,000. That's not uncommon. And the appraisal comes back, it gets accepted, but the appraisal comes back at $320,000, right? And you offer $330,000. So there's a $10,000 gap. Well, either the seller is going to have to bring that price down so that you can get a loan, because the bank's not going to give you more than what it's appraised for. So they'll bring the price down to $320,000, which is, I mean, it's not unheard of. It's pretty common. So they'll bring it down to $320,000, and they'll just kind of accept that they lost 10 grand. Another option would be like, they don't want to bring it down to $320,000 because maybe they got another offer, you know, for cash. That's $325,000. So you either have to pay out of pocket, you know, the $10,000 difference. That's an option. If you really love the house and if it's worth it, that's something that you could do. Another option would be that if you cannot come to an agreement, like they don't want to drop it down to $320,000 and you don't want to cough up $10,000 and there's no medium, like no one's paying anything, then you would have to cancel the purchase agreement. So those are your options. Title commitment. So title after the purchase agreement is executed and the inspection is done, the purchaser, sorry, I got a train coming. The purchase agreement is sent to title, to the lender, and all the parties that are involved, so they can start working on getting the property from one owner to the next. So they'll start doing all the background work at that time. They're gonna do a title search, they're gonna list all the owners, any kind of encumbrance, any kind of easement that wasn't disclosed. Maybe the neighbor owns a part of your garage because they built on their land. That stuff happens. Not common, but it happens. Maybe there's a relative that passed away. You know, one of the owners passed away, and the other partner didn't know that their son owned half of it. You know, so there's a lot of things that could happen on that end that is very important for title to make sure that everything is clear and it's safe. And I highly recommend you get title insurance because that will protect you forever as long as you own the house, for anything that has been missed, because you don't want to get the keys and then you got, you know, cousin Jimmy come knocking on your door and be like, hey, my uncle told me that he was going to give me this house and it's my house. What are you doing here? So you don't want that to happen. Actually got a question. Would you lose money in escrow if the appraisal comes up short? Great question. So if the appraisal comes in short and there cannot be any agreement between the seller and the buyer, they don't want to drop their price to move forward, you don't have $10,000 to keep moving forward, or you don't want to. You don't have to. You don't want to. It actually gives you an out because it is a contingency, a financial contingency. So if you decide to cancel it, then you are off the hook. You get your money back on your earnest deposit. So great question. You do get your money back. The only way you don't get your money back is if you back out because you just feel like it, you know, like you get buyer's remorse. That is a financial contingency because the bank is not going to give you a loan for more than what it's worth. So you will definitely get your money back. Good question. Final docs to the lender. So I'm sure you're just gonna, Cynthia's just gonna ask for more documentations. It's just part of the process. And towards the end, I would say 3 days prior to closing. So if you're closing on Monday, tomorrow you would most likely get your Alta. And in your Alta, it basically is an itemized sheet, kind of like a spreadsheet of all the fees. So it's going to have all the title fees, the originating fees, lender fees, your earnest deposit. It's going to have a credit. It's going to have everything. And then at the end, it's going to show like what you're going to bring to the closing. And that's where Cynthia touched about, like, you know, your cash to close. And it's going to either be wired or it's going to be a cashier's check. And yeah, so it's just going to be an itemized doc of everything that it's that you got to pay. That's closing time. Congrats. So now that it's the closing day, so let's say tomorrow is a closing day, right? I like to do the final walkthrough an hour before we actually sign anything, because you want to make sure that you are seeing the house in the same condition that you purchased it in. So we'll go to the house. Like if your closing is at noon, we're going to go to the house at like 10:30, 11 o'clock. And we're just going to do a little visual inspection. It's not the time to negotiate. We're just going to look at the house and nobody punched a hole in the wall, that the AC is still working. There's no giant leak coming, you know, or any kind of leak. Any new leaks. The basement's not flooded, you know, stuff like that. We're not looking at, you know, the outlets to see if they're working, or even a P-trap. If you saw like a P-trap under the sink and it started having a little drip, I mean, that's not something to blow up a deal over. That's like a $20 fix. So we're looking at like significant things that could really wreck your life owning the house, right? So we do a little walkthrough, make sure everything's good, and we lock it up. Then we drive to wherever we're closing. Sometimes you can close at the house that you're purchasing. We can do it at my office, got great views. We got Lake Minnetonka. We can close near your place, whatever you guys prefer. And then once we're at the closing, usually takes like 20, 25 minutes to sign your life away. And yeah, and then that's it. And then once you sign everything, the house is yours. Congratulations. Now for the questions, Q&A.
Oh, well, we have your mics off. So if you have any questions, please type them in. We'll give a minute to see if anyone puts any questions before we end for the day. Great presentation. Thank you so much, Victor.
Mm-hmm. You too. You did great.
Oh, we have one question.
Oh, what if a home is appraised, but then a significant storm were to hit and its value change / final walkthrough doesn't pass? So
that would put a kibosh.
Okay, so the house appraised, and then there was like a hailstorm, right? So there's nothing to like pass because there's no inspector. It's literally me and you, and like whoever's buying the house, right? Like, so as if it's the wife and husband, it's us three going to the house ourselves without the appraiser, the lender. I mean, it's just us, and we're going and we're looking at the house. We could visually see it. If there was any kind of leakage, I mean, we can check the ceiling. If the basement was unfinished, there's a lot of unfinished basements. You can kind of look, if there's some water intrusion. My experience, I grew up in Miami, so we didn't have basements. So when I saw a little bit of moisture in the basement, I was freaking out, be like, what is happening? But apparently a little bit of moisture in the basement is not the end of the world. It could be a couple of things. It could just be like, there's no gutters, right? Or the gutters are clogged. The grading is not, there's a negative grade towards the house and you always want it to be away. There's no dehumidifier. You can waterproof paint the basement blocks. So there's a lot of things that we could do to mitigate any kind of problem when it comes to like a storm. I wouldn't be concerned if I saw like a little bit of moisture on the walls from a huge, like how we had on Tuesday. I had a client, he texted me, he's like, hey, Victor, look, they closed on their house like a month ago, and they texted me and they were like, hey, Victor, look, there's some water here, and they're from Louisiana, so they're not used to basements either. And I reassured them, like, hey, it's not, that's a common thing that happens in Minnesota, especially in the spring when all the snow thaws. But they don't have a sump pump and they don't have a dehumidifier. And I told them, these are the things that you can do to prevent that. But it's not,
Can I
the end of the world for something like that. But if we did see, if we saw like giant like water stains, Ashley, in the ceiling, yeah, absolutely. I would take a picture and be like, hey, these weren't here when we bought the house. The one thing that we could do, we could extend the closing, be like, hey, you know what? We had a huge storm last night and there are some new water stains on the ceiling. I think there's a leak in the ceiling and we could extend the closing. I mean, there's nothing wrong with that. I would absolutely advocate for that. So we could do that, and then we send over an amendment, get a roofing company come out. He checks it out and says, you know what? Yeah, there's a leak here. We can negotiate. Hey, how can we remediate this? How can we fix this? And there would be two options. They could fix it, that week, get it fixed by the roofer, or it could be escrow. They can be like, you know what, it costs $2,000 to fix this. I'll give you $4,000 to fix it on your own. So there are some things that could that we could do if those things came up, but doesn't happen all the time.
Right.
I hope that helped.
And on the lending side, it would depend on what the damage was. It could shut down the deal or the deal until it gets figured out, because that could mean the seller has to involve their insurance company. Yeah. So it would just depend on what that damage is, but that very rarely happens. But yes, that'd be something that we would have to decide. What is the damage? How does it affect things? Was it significant or not significant? Does insurance, like if there's a whole roof off and we need a whole new roof, then, that's a different
You
story.
show the
So,
final walkthrough and there's no roof.
oh, that would be
I
terrible.
think there's a problem here.
Yeah, and then Maggie, Ashley, I hope that answered your question. So typically that's not going to happen, but it would depend on what the damage is.
Yeah.
And then you had asked about Maggie asked about multiple appraisals. So in the mortgage world, we have to order an appraisal through a service. Don't get to pick the appraiser. So we put in an order and it's picked up randomly by an appraiser. That's to make sure that the lender isn't saying, hey, Bob, I need 400 on this house, and all of a sudden it's worth 400. So it's supposed to keep it so that it's like an honest transaction. So we cannot go and get multiple appraisals because it could be looking like we're trying to get the value that we want because we didn't like that one. So technically, we have to use the appraisal that we get. Unless we can find something very significantly wrong with it, then we might be able to make that case. So let's say we did an appraisal, and as Victor had said, it came in that $10,000 lower. That is what we're going to use. That's the value of opinion by the appraiser. However, Victor would have an opportunity to come back and we have a form we would have him fill out. That's how we do it here. And he would say, oh, did you look at this comp? Or did you notice that this or that? We could give that form to the appraiser to have them relook at it to see if they would change the value of opinion. I can tell you in all the years I'm doing this, very seldom does the value of opinion change. But if you did have a comp or something, like I did have one time where something had just closed, that was because an appraiser can't use a comp unless it's closed. So it just so happened that during that time span, a different comp had closed. And by presenting that comp, it did change the value of opinion a little bit. But typically, no, we cannot get multiple appraisals. We have to use the one that was ordered at that time.
Yeah.
All right. Any other questions before we let you guys go tonight? See if anyone else starts typing. I love all the questions. That's really great. And I hope you have more questions, and we'll reach out to Victor and I. We would love to make this more personal and talk to you, about your journey, how you qualify your credit, the home you're looking for, help you set that purchase price, know the funds that you're going to need so that you can start that home journey confidently and understand the process.
Yeah. Yeah, a lot of people get they misunderstand I need so much to buy a house. I mean, just the down payment assistance programs. I could also negotiate, seller costs. So I've gotten a buddy of mine like $17,000. Actually,
Nice.
The one that had the sewer line issue, it was like around $15,000 to repair, and I got him $25,000 back for that. So
Nice.
so yeah, there's ways to
Yep.
to get things done. I mean, if you don't have a ton of cash, there's multiple ways to get these things done.
Right.
Yeah.
So I'm going to leave you with this. If you're thinking of starting the home journey, maybe you're on the line and you're downsizing, upsizing, there's been a change. Please get a hold of me. Let's talk. Let's figure it out and know. So you can figure out, is it ready now? Do you need to wait? Where are you at? Thank you so much, Victor. Thank you. Thank you everyone for joining us. We really do appreciate it.